Hi, this is Robbie Thomas, Bay Area Downsizer, bringing you the September 2025 update. Let's get into it. So, these are a few charts put together and basically showing the data. Keep in mind, this is 30 days delayed data. So, from the January of 2020, where the inflation target was around 2%, it was below 2% over here. It peaked in March of 2022 to 5.3%, and now it's at 2.9%, where the Fed's target is kind of like they want to be around the 2%. The unemployment is still holding steady, although the data that came out recently after this chart came out from BLS is that there were about over 900,000 jobs, which was revised lower since 2024 last year to now. So that means the numbers are going to be definitely much more skewed than what is here. But for a general understanding, July 2025 data shows 4.2% seasonally adjusted. Next is job growth that was very elevated in 2021 July. 900,000 jobs is now over here, which is less than 100,000 jobs. This also is what the marketplace pays attention to, because if there's no new jobs created, then there is this fear that the market is going to stall, and if that happens, then the Fed might reduce the interest rates again. Hence, the analysts and all the people on social media saying that there's going to be at least two more rate cuts, although there was a recent rate cut of 25 basis points. Here's the new concern that people have, people worrying about an upcoming recession. So, nearly 2 in 3 Americans think a recession is coming, while 74% of Americans admit that the world news or the current events affect their financial decisions. The Daryl Fairweather, the chief economist at Redfin, says that the Fed is in a tough spot. Some argue that with a weakening labor market, it's time to bring rates down. Others point to rising inflation and say a rate cut is misguided. The most likely scenario, the Fed will cut rates to stabilize the labor market, viewing any inflation from tariffs as temporary. But if that assumption proves wrong, we could be looking at rate hikes again in 2026. So it's not that rate hikes are not out of the question, it's possible. Now, a stalling job market makes a cut likely, is what I said earlier. But here's the thing, 25 basis point cut, 91.7%, which has already happened after this date. And no cut is 8.3%, but that's insignificant. Del Fairweather from Redfin also says that today's mortgage rates already have the anticipated September Fed rate cut priced in. This means that when the Fed officially announces the cut, we shouldn't expect a significant corresponding drop in mortgage rates. The interest rates actually came down below 6% this last week. Now, mortgage rates declined after weak jobs report. A 30-year fixed mortgage rate, August 1st, jobs report was released over here. And then right now, this is last month's. This month's is actually below 6%, 5.99. Now, expect two federal cuts is what they're saying. So this is, again, a consensus from the CME group. The 48.5% says there's going to be two more cuts, and this over here says three cuts. So the 30-year fixed mortgage rate projections as of 9/2/2025. Today is 22nd, 9/22nd, 2025. But quarter three consensus between Fannie Mae, MBA, and Wells Fargo is 6.68. Quarter four is 6.55. We're already below 6. Quarter one of 2026 is 6.47, and quarter two of 2026 is 6.4. Auditor Kushi, the deputy chief economist at First American, while there will be significant regional variation, the underlying fundamental conditions of the national housing market support a natural moderation of house prices rather than a sharp decline. Now, this information was sort of uh, considerable at that point when he came out with the statement. This was about last month, but right now, this week, there's a H-1B visa executive decision that President Trump passed, and which is adding 100,000 filing fee per candidate, which significantly affects the next year's hiring process for tech workers. And if we're talking about the Bay Area, predominantly the majority of the home buyers are from the tech sector, which drove the prices to these levels as of now. So there could be a significant number of people who are sitting in the sidelines as home buyers, and another group of significant home sellers who are going to put their houses on the market. So even with stalling prices, and though the interest rates have come down, if there's more supply that's going to be added because of this, then for sure there's going to be at least a sharp decline of maybe 15% in the Bay Area. Listing prices have already flattened and holding steady as of July 2025. But as of last month, it has gone slightly more lower to the lower end. But this is for national data. Bay Area prices have definitely stabilized and gone lower a little bit. Home price growth is the slowest since the summer of 2023. So percentage change in sales price year over year. It peaked in January 23. It was at 4%. In February 2024, it peaked to 6.5%. And then now in June 2025, it's come down to below 2%. So Daniel Hale from Realtor.com says that the housing market has cooled modestly in 2025, but the extent and persistence of rebalancing really varies across the country. And regionally, home buyers and sellers are likely to experience a very different market. Now, decades of downturns. This is just a timeline. So different major slowdowns in the housing market. So early 1980s recession, mortgage rates soared above 18%, freezing buyer demand. As soon as rates eased, sales rebounded quickly. 2008 great financial crisis, a deep drop in sales from a financial system a shock. Recovery took longer, but sales returned to normal levels. And the 2020 COVID correction saw sales pause during the shutdowns and then came back faster than any time in modern history. It spiked here. The number of sales increased was the highest in recorded history. In 2022 to present slowdown, high rates slowed demand again. Now the job market scenario has changed. Now with the new this week's H1B new rule is also going to slow down the tech sector purchase power. Now, median sales price of homes sold last 50 years, so this is a national average. We started off in the first quarter of 1963, well below 50,000. In 2008, over here, first quarter, you saw the biggest decline, and then it based out and took off again in 2011, fourth quarter, and continued to climb since that period, and peaked again over here at around 450,000, which is in 2021, 2022, and then started basing down in this flag pattern. So this isn't the first slowdown. The early 1980s peak was at 4 million sales. Trough sales were 2 million. Home sales drop was 50%. Prices dropped by 50%. And the time to recovery was 4 years. 2008, great financial crisis, 7.1 million peak sales rate. Trough sales were 3.5, and home sales dropped by 51%. And the time to recovery was 3 years. COVID 2020, peak sales rate was 5.6 million. Trough sales was 4.1. Home sales drop was 27%, and the recovery took 8 months. But 2022 2022 to present time, peak sales rate is at 6.4 million, trough sales rate is at 3.9. Home sales dropped 39% so far. I think this number is going to get over 51%. And time to recovery to be decided. Well, we had like 16, 17 years of continuous growth in the home prices, and in some areas in Fremont, it went up. The prices, home prices went up by 97, 98% in certain zip codes. That was completely untenable and unsustainable. So there is definitely a major correction in certain parts depending on the condition of the house, location, interest rates, job report, and like that. So down this time's recovery from 2022 to it's basing out. It hasn't based out yet. It's going to probably base out next year, 26, 27, and then start climbing again. But until that time, prices might go down maybe 15 to 25, 30%, depending on the location and the condition of the house and interest rates and job loss. And then it'll pick up again. But recovery probably will take this time maybe 3 to 5 years. US home price expectations. So most optimistic is 27.4% by 2029. So they're looking at it over here, and the lowest is 6.7% by 2029 from this 2025 range over here. The majority of builders are offering incentives. The percentage of builders that offer incentives per month hits record high. In August, it was 66% of new home builders are giving some form of incentive. Either they help with the upgrades or they help with the buying down the cost of the loan and closing costs. Builders are also cutting prices, although very, very hesitantly, depending on which area and which builder, because that's the last thing they want to do is the builder cut prices and the entire neighborhood's prices go down. Okay, so as a summary to the whole chart data, the market is definitely slowing down, and expect more slowdown with even with the interest rates dropping because of the job market. The scenario has changed because of the AI and new technology coming in. More and more tech companies are laying off their employees who they don't require. And added to that, this past week was the announcement of the H-1B tech worker visa, with the announcement of 100,000 per applicant that the companies have to pay, which is definitely going to slow down the hiring of tech employees since 2026 comes up. And that is definitely going to cause a pause because, as with all people, when they see something happening in the job market, people are scared, they're concerned, and they won't make a decision fast. So, if you have any concerns, anything related to real estate, and if you're going through a tough time with your job or anything, you just want to have a free consultation, give me a call at 510-374-2264. Robbie Thomas, Bay Area Downsizer. Bye.